All right, welcome to The Explainer. Today we're diving deep into a financial product that gets a ton of buzz, the YieldMax UltraOption Income Strategy ETF. You know it as ULT. And we're not just going to talk about it, we're going straight to the source, the official prospectus, to really see what makes this thing tick. So let's jump right in. So right off the bat, this is the big question, isn't it? It's the core promise. The whole reason a fund like ULTY even exists. They're all about delivering that high, regular income. But, in the world of finance, when a promise sounds that simple, the answer is usually anything but. And that's exactly what we're here to do. We're going to try and translate all that dense legal jargon from the prospectus into a clear picture of how this thing actually works, what it costs, and maybe most importantly, what the real risks are. Now, just a heads up, we're here to understand the mechanics. We are definitely not giving any financial advice.
Okay, so let's start with the absolute basics. Section 1. What is this fund actually trying to do?
The prospectus is super clear about this. The number one goal, the primary objective, is to seek current income. Now, it does mention a secondary goal, getting some exposure to the share price of what it holds. But, and this is a really crucial detail right from the start, that exposure is capped. It has a limit. So you can see the focus is all on income, not so much on growth. All right, section 2. Now we get to the really fascinating part. How does it actually generate that income? This is where we get to pop the hood and look at the engine. And believe me, this whole machine runs on options and volatility. So before we get too deep, let's just make sure we're on the same page with what an options contract is. It's basically a tool that gives someone the right, but not the obligation, that's key, to buy or sell an asset at a price they've already agreed on. You can almost think of it like a coupon that has an expiration date. It's a really critical piece of this whole puzzle. Okay, so one of the main strategies they use is something called a covered call. The easiest way to think about it is like this. Imagine you own a stock. You can basically rent it out by selling what's called a call option. When you do that, you collect a fee, which is called the option premium. That's your rent. So what's the catch? Well, in exchange for that rent money, if your stock's price suddenly skyrockets, your profit is capped. You get the income, sure, but you give up some of that huge potential upside. Now, ULTY takes this basic covered call idea and, well, puts it on steroids. The fund's managers are applying this strategy, plus a bunch of other pretty complex option strategies across an entire portfolio of stocks, usually somewhere between 15 and 30 different ones at any given time. So, how do they even pick which stocks to use? This quote from the prospectus basically gives away the secret sauce. The fund is actively hunting for stocks with high implied volatility. Now, that's just a fancy way of saying they want stocks whose prices are expected to swing around a lot. And why would they want that? It's simple. Higher volatility usually means higher option prices. More swings mean more potential rent money, and that's what fuels the whole income stream for this fund. Okay, so a strategy that's built to generate high incomes sounds pretty great, right? But what's the price of admission? Let's get into section 3 and talk about the fees and the real costs. So the prospectus lays out the annual fees pretty clearly. You've got the management fee, other expenses, and after a small fee waiver, you land at this number, 1.30% for the total expense ratio. That's kind of like the sticker price. But, and this is a big but, it's not the full story of what this thing actually costs to run. Because then you dig a little deeper into the prospectus, and you find this number. 717%. Yeah, it's a huge number. So you see that and you have to ask, what on earth is a 717% portfolio turnover rate? I mean, what does that even mean? Well, this number represents how often the fund is buying and selling all the stuff inside it. And a turnover rate of 717% is, well, it's incredibly high. It means the fund is basically buying and selling its entire portfolio more than 7 times over in just 1 year. All that frequent trading creates its own costs, higher internal transaction costs, and it can spit out more short-term capital gains, which, as you know, get taxed at higher rates. But here is the absolute key takeaway. These costs are not included in that 1.30% expense ratio we just saw. They are an extra layer of costs that can really eat into investors' actual total return.
Okay, this brings us to what is probably the most crucial section of all, the trade-offs and the risks, the fine print. Because with any investment, especially one promising high income, you have to understand what you're giving up and what risks you're taking on.
And the prospectus is, very direct about this. It says right there is no guarantee and that an investor could lose some or all of their investment. Now look, this is pretty standard language in these documents, but it's always worth hearing again. There are no guarantees here. The strategy might not work out, and it is absolutely possible to lose money, maybe even all of it. This slide really boils it all down to the core trade-off, doesn't it? On one side of the scale, you have the promise, the potential for high monthly income. But on the other side, you have the catch. Your potential for growth if the stocks do well is capped, and you're taking on a significant risk of losing your original investment.
And this leads us to one of the most critical risks, and it's called out specifically in the prospectus, NAV erosion. See, when the fund pays out that big, high distribution, its share price, the net asset value, or NAV, actually drops. The document warns that these repeated payments can, and I'm quoting here, significantly erode the fund's price over time. So why does that happen? Because sometimes that income check you get in the mail is really just the fund handing you back a piece of your own money.
And honestly, the list of risks in the prospectus goes on for pages, but here are a few other big ones to think about. There's derivatives risk, because options themselves are really complex. There's management risk, because you are completely relying on the skill of the fund's advisor to make the right calls. There's non-diversification risk, because the fund can be really concentrated in just a few names. And of course, there's newer fund risk. It just doesn't have a very long track record for people to look back on and evaluate. And just to really hammer this point home, the prospectus says it again in black and white. Distributions may consist of returns of capital. Let's be perfectly clear what that means. The super high yield you see advertised might not be pure profit. It could literally be the fund just handing you back your own money, which of course lowers the value of your remaining investment. You have to understand, this is a feature of how it's designed, not a bug, and it's a critical detail. So after tearing apart the prospectus, the picture becomes pretty clear, right? ULT is using a really complex option strategy to chase high income, and it's fueling it with market volatility. The price you pay for that potential income is capped growth, high internal costs you don't always see, and some very significant risks, including the risk that the fund is just paying you back with your own money. And that leaves us with the final question, the one that only you can answer. Is that the right trade-off for you?